Chris is a brilliant communicator, has a rare ability to make economics come alive for his audience, and has received immeasurable accolades for his meaningful and entertaining presentations. Please welcome Chris Caton.
Well, thank you, and let me say it is a pleasure to be here. Whenever you hear a speaker introduced, you should bear one thing in mind, that the introduction was almost certainly written by the speaker. But I can put my hand on my heart and say I did not write that one. And you might have been a bit confused. There's a few occupational health and safety regulations being offended up here. If I fall over at any stage, it's not my fault. You might have been a bit confused. I'm the chief economist at Bankers Trust, but before that I was the chief economist at BT. Sorry, the other way around. Chief economist at BT, before that at Bankers Trust. And it's actually the same organisation, just with a name change and a bit of a function change in the middle. And what that means is I've actually been BT's chief economist as of July this year. It was 22 years. There's actually a few people that have been there that long. Among other things, it's not a bad place to work. But of all the people that have been there that long, I have one unique distinction. I'm the only one of those people who has never ever been promoted. So that'll give you some idea of the level of competence you're dealing with this evening. First of all, I hope you've had a good year. If you've been invested in any share market pretty much anywhere in the world, you should have had a good year to date. I've had a great year. Thank you so much for asking. Not least because of something I did on my own initiative back last December. I went out and I bought myself a very unusual Christmas present. I went out and I got a new left hip. And I've discovered very quickly that hips are very much like wives. The new one is a vast improvement on the old one. But the transition involves a lot of pain and costs you a lot of money. So very similar. This is a true story. I went back to see the surgeon in January and I said, I've just got the feeling now that my left leg, the one he operated on, is shorter than the right. And he said, oh no, it can't be. But sure enough, he measured it up and it is. So, I've always thought economics is an inexact science. I didn't realise orthopaedic surgery was inexact also. But he said, he was very positive about it. He said, don't worry too much about this. He said, I can fix this 3 or 4 years from now when I do your right hip. And I said, I've got no problems with my right hip. And he said, let me show you the x-rays. You will have. So, it doesn't matter how old you are, does it? It is always nice to have something out there that you can look forward to. And also, it doesn't matter how old you are, does it? Some of us get dragged kicking and screaming, but we all do it. We all basically move to the new technology, almost no matter what it is. I took a big step a bit less than 4 months ago. At the behest of BT, I got myself on Twitter. And everything you've heard about Twitter is absolutely correct. I've just gone viral. I've been on it less than 4 months and already I've got 38 followers. It's just been huge. I think I actually had more followers when I was on RSVP. Although over there they're called stalkers. They're nothing to do with what I want to talk about. I want to give you my view, if you like, of the big picture. What's happening in the major economies of the world, what's happening in the Australian economies, what that all means for financial markets. I understand there's an election coming up this weekend. I'll touch on a matter briefly related to that towards the end. When Australian economists talk about Australia, they always begin somewhere else because what happens offshore matters so much for Australia. And there have been 3 major influences on the Australian share market and hence on Australian investors this year. 3 international influences, and those are the United States, Europe, and China. And dealing with them in turn, first of all, the United States, you can never ignore it. It's the biggest economy still in the world. It's not so long ago that we were worried about the so-called sequester, whereby they had these mandatory across-the-board cuts in government spending. But the main concern out of the US right now, apart from possible military action against Syria, which if it has a market effect will be short and sharp and quickly reversed. But the main concern in the US is the aftermath, if you like, of this program they've been engaged in for some years there called quantitative easing. Now, you may have heard this described as, oh, they're just printing money, it's inflationary. If that's your view, well, if anybody's told you that, they're wrong. But quantitative easing is a process by which the Federal Reserve in the United States has been purchasing $85 billion worth of long-term bonds and mortgage-backed securities every month. Now, what this does is it drives down long-term interest rates, and so stuff that gets financed, such as, well, that drives down mortgage rates, for example, and finances housing activity and other capital spending. And as a result of quantitative easing and lower long-term rates, the US economy does better than it otherwise would have, and that's a positive for the share market. And if it's positive for theirs, it's positive for ours. And it doesn't stop there. Quantitative easing has one other market effect. Because interest rates are pushed down so low, investors have got nowhere else to go to get a return. So there's a double effect on the US share market, if you like, and hence on us. So analysts have taught themselves there's a link. Quantitative easing good for the share market. Now, of course, in May, and obviously what that means is that when they stop quantitative easing, that'll be bad. And in May, Ben Bernanke said, we're not going to do this forever, obviously. And he said, we'll probably stop probably sometime around the middle of 2014. And before we stop, we will taper. So we'll still be purchasing bonds and securities every month, but we won't be purchasing as many. Now, let me show you the link so far, if you like, between quantitative easing and the US share market. The blue line here, it's the size of the Fed's balance sheet. When they engage in quantitative easing, their balance sheet expands. So that doesn't sound good, does it? So you can see the period of quantitative easing earlier, and you can see this one. And so that's the blue line. The red line is the US share market. Now, you either see a relationship here or you don't, and most people do. Now, bear in mind, and that this chart actually goes up to about the point that Ben Bernanke spoke in May. But bear in mind, what he said was the first thing we'll do, and we won't do it yet, but the first thing we'll do is taper this. So the blue line will still be going up. Now, if there's any relationship here at all, what does that mean for the red line, the share market? Still positive. But of course, markets had to get used to this, the fact that it was going to end. And so when Bernanke made this announcement, roughly speaking, over the next couple of weeks, the US share market fell by about 3%. Over the next month, the Australian market, true to form, fell by 10%, although there were other issues going on there. But when you think about it, essentially, as far as markets are concerned, quantitative easing has already ended. They've already factored in a response to the end of quantitative easing. So when they do end it, and they won't do it unless the US economy is doing better, when they do finally end it in the middle of next year, when they announce in a couple of weeks that they're going to start the taper, there doesn't have to be a big market reaction. We've already had it. There will be some volatility, probably, but don't worry about quantitative easing in the United States. The other thing that you don't have to worry so much about as you may have thought is you don't have to worry about Europe. And I got this one right. A year ago, I'd tell people that we're making far too much fuss about Greece. Greece is a very small place these days. A year ago, I told people that the Greek economy was smaller than the economy of the city of Philadelphia. And there's nothing that could happen in Philadelphia that would worry you as an investor, so why should we be worried about Greece ever? And that's turned out to be correct. No matter what else is true, the European debt situation is looking a lot better than it was. And incidentally, their economies are looking better too. And I know the debt situation is looking better because I've constructed a trouble index for Europe. Something I use at least weekly to just have a look and see how Europe's going. It's very easy. You can use it too. You just look at their long-term interest rates. After all, if you, a country, have a debt problem, financial markets will still hold your debt. They'll just want to be compensated more for it. So your long-term interest rates get bid up. And now this makes your problem worse because now if you issue new debt or refinance old debt, your interest costs go up and that adds to your debt. So the day financial markets decide you've got a debt problem, you get a bigger one. And they tend to react to that. So interest rates tend to spiral upwards, and that was clearly happening in the first half of last year. These aren't quite the interest rates in these countries. They're actually the difference between the long-term rates and the German rate. You just kind of take that away as a benchmark. Got the pigs on the left, very different scale over there. The Greek story is the one that was interesting, of course. In the first half of last year, after that vertical, that was a debt restructuring, But in the first half of last year, when they were going through that one-step, two-step election process, as you can see, their long-term rates just going up, up, up. And concern about what it would mean for the world financial system if Greece left the euro. And those concerns, among other things, drove our share market down to about 4,000. It's 51.20 today. And you can see, as I said, Greece doesn't matter. The two that do matter in Europe, the two that will determine whether Europe hangs together or falls apart, are the two on the right, Spain and Italy. They're the big ones. And you can see in the first half of last year, their trouble getting worse. Interest rates going up. Now, in July last year, inspired by some ECB rhetoric, among other things, as you can see, basically since July last year, every single line on this chart has been coming down. The trouble has been getting better. Now, this chart's actually about a month out of date. So I want to take the two that matter, Spain and Italy, isolate them, bring it a bit more up to date, forget about the differential with the German rate, just show you the decline in those rates, if you like, since the peak. And that's what they look like. Same pattern, of course, on the downswing through to, looks like sometime at last week. Now, financial markets have drawn two lines in the sand. When your long rate gets to 6, you're in trouble. And when it gets to 7, you're in deep trouble. And it's clear, July last year, Spain was in deep trouble and Italy in trouble. Now, they're clear of trouble. Now, they still have debt problems. But they're now in a position where they can slowly, improve them. They've certainly stopped getting worse. And so financial markets now worry less about them. So among other things, the share markets rallied. Incidentally, you can see that peak there. They peaked on the same day. The Spanish bond rate peaked at 7.5%, as you can see. And on the same day, the Italian bond rate peaked, and it's not quite clear here, but it actually peaked at 6.66%. And when I saw that number, I was very happy because I have to remember a lot of numbers. So anything that makes that easier, I'm grateful for. And when I saw that peak, 666, I thought, that's easy. I thought, that just happens to be my ex-wife's phone number. And incidentally, if you've been through marital separation, I might not be the only one. And if you've got any degree of introspection whatsoever, you sort of owe it to yourself, once the dust is cleared, to ask, did I miss some signs? Were there some signals I should have picked up on and I didn't? And I have to admit, in my case, yes, there were. You know that U2 song, I Still Haven't Found What I'm Looking For? She had that played at our wedding. That was a clue, wasn't it? I just missed it. But what about the third thing? The third thing that's been a big influence, and it's been an influence on the market and also on the economy, is, of course, China. We were reminded of that yesterday. But in order to understand the effect that China's had, you've got to start with the good side. And the good side was the 10 years to 2011, if you like, when China grew by 10% on average every year. And that growth was dominated by infrastructure and residential construction. And that stuff uses a massive amount of steel. And just to give you an idea of China as a steel story, per unit of economic output, per unit of GDP, they use steel at 4 times the global average. What that means is they use more than half the steel used in the world. And I like this one. Since 2007, China has used more steel than the US economy did in the previous 100 years. It's just been it's a massive story. Now, if you're using all that steel, you need a lot of iron ore. And every year they wanted more and more of our iron ore, and they were prepared to pay a higher and higher price. And commodity prices went up year after year. In Australia, experienced these massive real income gains, some of which you might think you didn't get any of them. In the peak in 2011, the gains we got from the commodity price boom, compared with if prices had just gone at the rate of inflation, if you like, the gains we got in 2011 on a per capita basis was $6,000 per head from the commodity price boom. And then, now you might think, well, I didn't get any of that. And you're right, it wasn't distributed fairly, but equally, I should say. Gina Reinhardt got more than $6,000, I'm pretty sure about that. But that balances out to some extent because the kids got nothing. But but you did get some of it because it was those rivers of gold that flowed into the federal government's coffers that basically caused them to cut income taxes 8 times in a row and led to all that middle class welfare. So, it was spread around a bit through the budget, and of course we're paying the price for that now because the budget's extraordinarily sensitive to commodity prices, and we gave it all away on the upswing. In 2011, the story changed. China began to slow in late 2011. And for a while there, everybody said, it's just cyclical. They'll have a slow year, then they'll be back. Nobody believes that anymore. 10% is no longer the new norm. Going forward, 7% growth, maybe. And of course, when China slowed, the first thing that happened is steel production stopped going up. On the way up, of course, our mining companies had basically said, we need to gear up for this. They're going to need more and more of our resources. We need to engage in all this capital spending to expand our throughput. And in very short order, mining capital spending went from 2% of GDP to 8%. And it was the biggest single force of growth in Australia. Then, as I said, late 2011, the story changed. Steel production in China flattened out. The iron ore price hit 180 and went down to 90. And when you go from 180 to 90, some of the plans you made at 180 don't make sense at 90. So a lot of mining capex plans have been cancelled or postponed. So basically the source of most of the growth in Australia in recent years gone away. And as a result, economic growth in Australia has slowed significantly. And I'll come back and show you that in a few minutes. And there were some calls, you still hear them, that maybe we're on the way to recession. I think that's very, very unlikely. What we're going through is a transition in growth caused by the peak in the mining capex boom. That's not the peak in the mining boom. We're still going to be selling them more. But it's caused by the peak in the mining capex boom, and I frequently get asked, what's going to replace mining capex as a source of growth? And the answer to that is no one thing. But everything that's stimulated by low interest rates, and we're at a record low now, lower exchange rate, it has come down, and I have to acknowledge the surge in business confidence that we're either experiencing or will experience after this weekend. In the meantime, we've got this slow growth period, and it's a China story, really. This is now going, as I said, next 10 years, they're not going to grow by 10, maybe 7, and that growth's going to be tilted a bit more towards private consumer spending. It doesn't use as much steel. Now, when you do the maths, they are still going to need more of our iron ore, more of our coal, more of our LNG, but not at the pace where we're going to get the easy real income gains year after year after year. And that's why, when both parties do the budget arithmetic now, they say, there's no way to get back to surplus quickly. We got into surplus as quickly as we did because we had a massive commodity price boom. Gone. What about the major economies of the world? What's the view, and in particular, how has that changed? And that's what this slide and the next one are designed to answer. Every number here is a forecast. And it's a forecast for GDP, or economic output growth, for this year, calendar year 2013. They're not mine, they're put together by panels of economists and analysts around the world, and there are so many numbers here because these panels update their forecasts every month. So here's how you read it. First column, when these panels were asked way back last October, what's Australia going to grow by in 2013? What's New Zealand going to do, etc.? Those were their answers. Last column, the same question, but the answer was given in August. Now you get the stories here if you look along the lines. And what's the general view when you look along the lines? Well, the bottom line really sums it up. We've shaved our growth forecast for this year. The world economy isn't going to do quite as well as we thought it was going to do last October. That's a fairly common story. Notice in China that forecast has come down quite rapidly just in the past 4 months. That's really a realisation that this is a new world rather than just a cyclical slowdown. The one economy, Australia's growth forecast come down, no surprise there. The one economy that has bucked the trend is Japan. Their growth forecast still low, but triple what it was last December. That's a tribute to Abenomics. It's one of the reasons why the Japanese share market has been one of the strongest performers in the world, but it's been very, very volatile also. Now, it's September. If you're looking at a forecast, you should be looking at next year, shouldn't you? Here's the same treatment for next year. We haven't been forecasting next year as long, a few messages here. First of all, notice more growth expected next year than this year. So the global economy is still stuck in slow growth, but expected to do a bit better next year. A lot of that comes from the US. The Australia expect to pick up slowly next year, but growth is still quite modest. So the global economy, basically, it's okay, it's not great. What about financial markets? When I put this together a few days ago, our currency was 89.3 US cents. It's been up sniffing around 92 today. I've told every audience I've spoken to in the past couple of years 2 things about the Australian dollar. Number one, it's got to come down one day. This is ridiculous. It was levitating. And number 2, don't believe anybody's forecasts. We're not very good at this. But it has finally come down. But the gist of what I said, and I said it for a long time, I wouldn't be surprised if people stopped believing me. But the gist of what I said was when we were above $1, the rest of the world was on sale for Australians. And that didn't matter whether you were an online shopper or a traveller or an investor. The rest of the world was on sale. And it was a screaming sale. It's possible there's still a bit of downside to come in my view, and I'll come back to that. The official cash rate, probably most people in this room don't want interest rates to fall anymore. You might be lucky. The Reserve Bank cut to a record low in early August. At the time, they're trying to handle this transition in growth. It's been a bit slow. The stuff that's got to pick up in growth has been a bit slow coming through. I think of it as in this way. They probably hope they're done, but they will cut again if necessary. They don't have to worry about inflation. It's too low to worry about. They do have to worry about the labour market. Unemployment is also low in Australia, but the trend is a bit discouraging. So it's possible we'll get another rate cut, but I don't have one in my forecast. I won't talk much about 10-year bonds and the share market. We're somewhere close to that first column. Remember, I said middle of last year we were 4,000. And at the time, it was clear, screamingly clear, that the Australian share market was cheap. Now, we know 2 very important things about cheap share markets. They can get cheaper, but they don't stay cheap. You can no longer look at the Australian share market and say it's cheap. So if you haven't been in, you have, unfortunately, in my view, missed the best bit. I'll come back to that. Here's the currency. The 2 lines here, the red line is the Australian dollar in US dollars. Look to the right. The other line on the chart, the yellow line, is what they call a trade-weighted index of the US dollar. So that shows you the US dollar measured against the currencies of all of the developed world that the US trades with. Now that line's inverted, so when the yellow line's going up, that's the US dollar going down, and when it's going down, that's the US dollar going up. Now forget about the last 5 years, look at the first 8. What do you see? Do you see 2 lines that for about 8 years moved together, roughly? This is the little known secret of the Australian dollar. In those days, we hardly did anything. Because if you see 2 lines that move together, that says in those days we went up when they went down, and we went down when they went up. And that pattern was there for so long that I decided, okay, the yellow line, that's fair value, that's where we should be, that's the right answer. And I used to use this as a forecasting tool, but I can't do that anymore, can I? There's been a gap there, a big gap for more than 3 years, but I still think that is the right answer. I'm not suggesting we're going to fall as far as the yellow line, which is about 82 or 83 cents, but I'm suggesting we could. Here's this is just something about the volatility of the Australian dollar. It's a monthly chart. The columns tell you for each month, and I think the last point plotted there is July, for each month, just the average daily trading range, the difference between the high and the low for the month, for each day, averaged over the whole month. And it might surprise you to learn that, even over the long term, the Australian dollar trades through more than a cent every day, on average. During the GFC, as you can see, that was close to 4 cents a day. Amazing stuff. And its volatility has picked up, as you can see. But so I don't know whether if you buy your traveller's checks in the morning or your travel card in the morning or the afternoon, it can make a difference, unfortunately. Here's the share market, end of month chart. I think, the last point plotted there should be the end of August. I did get that in. But you can see essentially the rally since the middle of last year, and then the choppiness basically since Bernanke made his announcement in May. Now this longer term roller coaster ride has done this to the market's price earnings ratio. And look at the one on the right. That's the price earnings ratio for the entire market. I've got the 3 sectors here. The horizontal lines are just the 10-year average. There's no magnet in them. But as a general rule, if the price-earnings ratio is significantly above that line, the market's expensive. How do markets get expensive? Because people love them. And when it's below that line, they're cheap. And as you can see, this was the basis of my statement in the middle of last year that the Australian share market was clearly cheap. You can't look at this anymore and say it's clearly cheap, unfortunately. So the gains from now on are going to be a bit harder to get. Now, coming to the Australian economy, this is our rate of growth over the previous year, the yellow line. And the red line is the same thing for the United States. Australian economists put this chart up because historically there was a close fit. Our economic cycle was highly correlated with theirs. Bearing that in mind, you can just see the extent to which we dodged the GFC. We really did. There were a number of reasons for that, but one of the reasons for it was the rapidity of the fiscal policy response. And it astonishes me to this day that the government gets no credit for that. But I'm more interested in the bit at the end. You'll see in very short order, since early last year, growth in Australia has slowed from, let's say, 4.5 to 2.5. And when we got that 2.5 figure, which we did 3 months ago, and we got pretty much the same figure yesterday, not up here, there were people who said, but, it's 2.5% growth, it's true, but if you take exports out, it's less than 1. I think I learned in primary school that if you've got an average and you take out the stuff that's above average, the average goes down. Not sure it means all that much. But there was speculation. Well, you look at the trajectory. We were 4.5 and now we're 2.5. How bad can this get? Well, I think it's because it dipped below 2.5 and because I got that nice white line going backwards in time, you can actually use this chart to ask, how often does this happen? How often does growth slow as it has in the past year? And what generally happens next? And just going backwards in time, you've got an episode since the GFC, although growth wasn't much above 2.5 when that one started. Then you've got the GFC itself, special case. Then you've got 2006 and 2003 and 1997. Two messages. Slowdowns of the type we've gone through are not that unusual. And certainly, in the past 20 years or so, they've never led to a recession. All we're doing is waiting for the stuff to come along that will return, that will cause a pickup in growth in Australia. Will happen. We may not be at the trough yet. The thing that the Reserve Bank will be watching like a hawk, if it's thinking about cutting rates again, is the labour market. I've got two indicators here. Employment, the red line, sluggish growth in the past year. The unemployment rate, the yellow line. Now, as I said earlier, unemployment in Australia is low. There's not too many developed countries where it's as low as in Australia. And don't listen to those who say, of course it's low, the government changed the definition. The government doesn't do the definition and nobody's changed it. It's low. But have a look at the trend since early last year. And this is the Reserve Bank will be watching this like a hawk. And, if the trend continues, it won't be long before unemployment in Australia is higher than it was at the worst point in the GFC. I guarantee you this, if unemployment gets to 6%, they'll cut rates before the next meeting if they have to. This is very, very important for them. Now let's go back to the red line for a minute. Employment growth's been sluggish. We all know we've got two-speeded economy. So... or maybe more than two. So if employment growth is sluggish, then there presumably have been industries that have added jobs, and there must be some that have lost jobs. So does anybody like to volunteer anybody to go into either of those two categories without looking down at your handout? These are the figures for the year to May, and this is what usually happens. Nobody answers, so then we do thumbs up or thumbs down. What about manufacturing? Thumbs up or thumbs down? Down. Retail? Down. Up, I'll remember that. Construction? Down. Year to May. How about mining? Down. So you're just going to vote everything down, aren't you? Here's what happened year to May. Manufacturing, you got right. Retail added jobs. That might be one reason why retailers aren't making much money. Construction added jobs. Mining lost jobs. Right. The clue actually to the Australian economy and where the jobs growth comes are the second one and the sixth one. Healthcare and social assistance and education and training year after year after year are the biggest sources of jobs growth in Australia. And we keep being told, what's going to happen if manufacturing employment keeps falling? In the past 20 years, the Australian economy's added 4 million jobs. and none of them in manufacturing. We've done it for 20 years, we can do it for another 20. I'm always fascinated by this one right up the top, transport, postal and warehousing. What the heck is that? I've actually figured out, well, I know one group that's in that. You know, those people that basically, you've ordered something on the net and they come round to your place and you're home, but they don't care. They just slip a little thing in your post box which says, we came to deliver this, you weren't home, pick it up at the post office. I figure, but you'd think they wouldn't need more people to do that every year, would you? I'll skip over that. And the other thing that the Reserve Bank worries about a lot, of course, is inflation. And inflation in Australia also low. The Reserve Bank says just a bit more than 2%. Now, this causes some consternation also because, you don't... Well, first of all, it's important that it's only 2 because the Reserve Bank's supposed to keep it between 2 and 3. So if it's closer to 2 than 3, they just don't have to worry about it. But how can inflation be 2 and yet we keep hearing about the spiralling cost of living? How can that be? Spiralling cost of living stories are mainly media and political beat up, and they cherry pick 2 or 3 prices at the most. Always electricity, petrol when it suits them, and then whatever else has been going up. And I'm not making this up. 2 or 3 months ago I read one of these stories and it said the cost of living is spiralling. Electricity's up this much, petrol's up this much, and look how much it costs to buy avocados these days. The ABS, on the other hand, measures hundreds of prices. What's the difference? How can they get a low number when if you just pick 2 or 3 you get a high number? All the electronics, all the consumer durables. Inflation in Australia is genuinely low. And that's, won't stand in the way of a further rate cut. Now, does it make any difference when they cut rates? Makes a difference to your incomes, doesn't it? But does it make any real difference in the economy? It's taking time to show through this time, but it has had some effect, as it always does. And the first place you look for a rate cut effect, we'll start with the chart on the right here. This shows you for your average household in Australia just the share of their after-tax income that goes to pay the interest on their debt. And I want you to focus on that last sharp upward bit, then the down, then the up, and then the down. And those, of course, correspond exactly to interest rate cycles. Now, where's the first place you look for an effect? Something to do with housing? House prices? If you did, you'd find it perfectly reflected. These are indexes, so you've got the Melbourne index and Australia, and where the previous line goes up, down, this one goes down, up. In particular, the last time we were raising rates and then we turned around and cut them quite sharply, house prices had been falling and they turned around and rose sharply. And incidentally, no more so, in no other capital city did they go up as rapidly as they did in Melbourne in, it looks like 2009. That's a massive house price rise. They've turned again. Why wouldn't we get another 20% over the next 12 months? Well, there's a few reasons. First of all, we're not going to double the first homeowners grant as we did last time. Secondly, we cut by 4% then, we've cut by 2.25% now. And thirdly, there's still this nasty little feeling it's all a bit too overcooked anyway, isn't it? Australian housing's in a bubble, isn't it? It must be, because people keep telling us this. What do the bubblers say? They all do this. It comes down to the same thing. They basically calculate how many years of income it costs you to buy a house, and then they do 2 things. They say, look how much higher that number is than it used to be, and look how much higher it is than anywhere else in the world. I borrowed the next 2 slides from Glenn Stevens to throw a bit of light on that. Here's his take on the first of those. There's his dwelling price to income ratio. You get bigger numbers if you just use dwelling price to wages, but there's usually more than one wage earner in a household. But there's the line for Australia, and there it is for the United States. We are guilty on both counts. Over the past 30 years, house prices have gone up, but basically now twice as expensive relative to income, and they're twice as expensive as they are in the US. Clearly, to come back into balance, house prices in Australia have to fall by 50%. Good luck with that. But it's a bit facile, isn't it, to compare yourself with one other country, albeit as important as the US. So in his next slide, Glenn threw a few more into the mix. Now, he didn't cherry pick. He's put New Zealand in there, the United Kingdom, a couple of countries in continental Europe, Japan. So the next slide is a lot busier. There's a lot more lines on it. The Australian line's still there. All you have to do is find it. Suddenly, We're not out the top expensive, are we? So that bit's gone. What about the other bit though? If you don't have to squint too much to see, it's not everywhere it's true, but in many places since about the mid-90s, house prices have risen relative to income, haven't they? In a lot of places. If it's happened in a lot of places, there could be one overriding reason. There's you can come up with lots of little reasons, but if there's one overriding reason causing house prices to rise more rapidly than income in a lot of places, what do you think that could be? And my answer is, well, demand, yes. My answer is, it's low inflation. How does that work? How does low inflation cause high house prices? Answer, when inflation is low enough for long enough, what happens to nominal interest rates? They come down and they stay down. Now think what happens when a householder goes to a bank to get a loan. The only real calculation they do once they know you've got the deposit is, can you service this loan at your current level of income? In the mid-90s, where those two lines all start to go up, the variable mortgage rate in Australia was 10.5%. It's now 6%. Obviously, for somebody with a $200,000 income then and now, they'll give you a lot bigger loan now. Now, of course, for an individual householder, they'd say, well, I've got to get a bigger loan. Look what's happened to house prices. But when everybody can and does take advantage of lower nominal rates and get a bigger loan, that's what pushes up house prices. So I reckon the upward trend here is a one-time adjustment to lower nominal interest rates, which doesn't mean it's going to continue, does it? Unless nominal interest rates keep coming down. But it doesn't mean we're in a bubble either. If you like your house prices in thousands of dollars, incidentally, this is what they look like. There was a time there when Melbourne was below Perth and Sydney and Canberra, but now you're back in second place here, as you can see. And you can see pretty much, certainly house prices have stopped falling everywhere. It's not clear in some places, I guess it's clear in Perth and Melbourne and Sydney and Canberra that they're on the rise and not so much necessarily elsewhere. Now, coming back to the overall economy, as I suggested, we're not yet necessarily at this trough in growth, but we will be there. And everything that's helped by low interest rates, low exchange rate, better business confidence will kick in gradually. Now, I mentioned earlier the political debate. I try to stay clear of this. Private sector economists do stay clear of the political debate. Generally speaking, that's because it's considered to be a CLM, what they call a CLM, a career-limiting move. Realistically, I don't have much more of a career to limit. And I have to say this, the bloke that's out there swinging from the hips, Saul Eslake, an excellent economist, he's, shall we say, my generation also. But, I stay clear of the politics because I wish they'd stay clear of the economics because they're not very good at it. And there's been one major economic furphy that has been perpetrated on the Australian public in this election. And that is the idea that somehow or other we have this massive amount of federal government debt that's impoverishing us or our children or our children's children or whatever. This is complete nonsense. It's easy to say, $184 billion worth of debt, big number. Going to $250 billion, big number. Is it? How would you figure out whether a country's government debt level is excessive or not? You'd have to compare it to something, wouldn't you? Like the size of the economy. That would make sense. And to gauge it, if you like, you could say, okay, here's our debt relative to the size of our economy. What happens in the rest of the world? And when you do that, this is what you get. In fact, it doesn't even show up. It hardly shows up. There are columns there. There's Australia's federal debt to GDP ratio. So basically the debt relative to 1 year's output in the economy. There are 4 columns there because it's this year, next year, the year after, and the year after that. And there's a few other countries which together represent most of the developed world. Now, it's true none of those places are paragons of debt virtue. But to assert that little old Australia has too much government debt is just plain silly. There's no other word for it. Or dishonest. Now, coming to the long term, going back to the consensus forecasters and saying, don't tell me about this year or next, tell me about the next 10, who's going to grow and who's not. They've given me this table, and they said put Australia at the top of the list. We're expected to outgrow every other country on this list for the next 10 years, and so this isn't a bad place to live, work and invest. I incidentally participate in the survey that generates these numbers. The firm Consensus Economics writes to 450 economists around the world, and we send them our forecast. We only do the long term every 6 months. So every 6 months I get a form that looks like this, except there are no numbers on it. I've got to fill mine in. I don't do all these economies, so if I don't do them, I just leave it blank and send it back. Down the bottom there's a space for comments, and I always write the same thing. In fact, I cut and paste it. And what I write is this: I don't care where Australia finishes, as long as we beat New Zealand. And you can see they put up a reasonably good fight, but we did it. Now, while I've been prattling, you've been thinking, where are the interesting stories? Where's India? Where's China? Well, here they are. I put these are basically growth rates for Asia. I put Australia back in. It's no disgrace to be outgrown by Asia. They're still playing catch up. I would call that a dead heat for first between India and China. I think India's had a rough year or two, so I think when these forecasts are redone next month, India will drop below China. But one day India's going to outgrow China. One day. And there's a very simple reason for that: demographics. But even, we have engaged more with India. In 2000, they were our 14th largest export market, and they're now number 4. But they'll never be the resource market that China is. But you will hear more and more about the Indian growth story in the next couple of decades. Coming to a more conventional summary, in the US, you remember we talked about the big question there is, when will quantitative easing be tapered? And what will happen then? Answer: there will be volatility. Answer: probably within 2 weeks they'll start the taper. There will be volatility, but we've had most of the market reaction. You don't have to have a major market depressant when that happens. Eurozone debt still a serious issue. We'll still be talking about this a couple of years from now, but the chance that's going to end in catastrophe certainly perceived to be significantly less than they were in the middle of last year. I never thought they were great. We'll always worry about China. That's just a reflection of just what a great story it has been. Going forward, it will only be a good story. The Australian economy should continue to experience only moderate growth, 2.5% in recent figures. Mining investment boom has ended. So far, the decline doesn't look like it'll be too steep. The cash rate may fall again. The exchange rate's still above fair value, and thus may weaken further. Incidentally, I told you if interest rates get to 6%, we'll get an interest rate cut for sure. I reckon if the currency gets back to 95, we'll get an interest rate cut for sure. The Australian share market is close to fair value right now. I think of these as the important messages I've tried to deliver. I always leave my most important message for the very end, and that's this one. So I'll stop there and I'll take any questions you may have. Yes?
Did you say the QE main and the staff cuts taken the fortnight?
Yes, on the 18th of September at 4:30 in the morning Australian time. There's a federal open market committee meeting on the 17th and 18th, which they will almost. If they the thing about this meeting, they would announce it at a meeting, right? And that's why I said September 18th, as the meeting ends that day. There's a press conference only after every third meeting. So if they don't do it this time, the probability shifts to December, not October. But yeah, September 18th is the most likely day. Yes.
I noticed that German growth is very low and expected to remain low.
Whose growth?
German.
Yes.
Is it dragged back by the East German economy? Or?
I wouldn't have thought so, but these are its long-term growth prospects. I showed you short-term ones earlier. Germany had a surprisingly good year last year, a lot of exports there, and then this year, every time you look at it again, you tend to drag those forecasts down. But it had a couple of quarters of negative growth, and now it's growing again. But its long-term growth prospects, are not all that flash, as you can see, although they beat a number of other European countries. Generally speaking, the people down the bottom tend to have relatively low population growth. Germany's basically nowhere in Europe, certainly in continental Europe, growth prospects are massively high.
So just on that chart also, from the United Kingdom down, inflation's higher than GDP. Does that suggest they're going to run into increasing inflation challenges and problems, steadily increasing?
No, I wouldn't have thought so. Now, bear in mind that you don't take the first column is what they call real growth, so it's already adjusted for inflation. So you don't take the second column away from the first. You can add it to it and get nominal growth, but you don't take it away. Yes.
Chris, as both the political parties seem to think that the development of Northern Australia is going to be a big thing in the future, what do you feel about that?
This is not something I've looked at that I've looked at closely. So from now on, I really have no expertise on that. I suppose that the sort of measures that were sort of thought bubbles, I think that's the word, or those are the words these days, the sort of measures that were thrown out there don't make a lot of economic sense. But I suppose it is, if we're going to basically say, well, we need to do something for the Northern Territory. Of course, Northern Territory income growth has been quite good, certainly relative to the rest of the country. Maybe we should also be thinking about right down the other end, about helping out Tasmania a bit. Those, if you think you have regional economic issues, they are, of course, correctly the domain of fiscal policy. You can't do anything with monetary policy there. There's one interest rate for everybody. I haven't looked closely at this, but I would say that the sort of measures, that basically having a lower company tax rate for companies in Northern Territory than elsewhere doesn't work. It's not real hard to kind of set up a head office in Darwin when most of your operations are elsewhere. It's just that doesn't work. But there are other legitimate fiscal measures you could do. Yes.
The US, I think, is going to hit its debt ceiling supposedly
It
very
is.
shortly.
Yes.
Do you think that's going to spook the markets?
I doubt it. US politicians have become a lot more mature about that. You may remember back in August 2011 when they hit the debt ceiling, and hitting the debt ceiling and raising the debt ceiling is just a simple accounting exercise. But in August 2011, it became a political bun fight, and there were major market perturbations, which of course we felt also, and as a result of the fiscal fiasco, political fiasco, if you like, the US lost its AAA debt rating, and we've still got ours. It was a major market issue that time around. They did, of course, there has been another subtle raise since then. I think politicians on both sides now kind of a bit more mature about that. I do remember thinking back in August when this was going on, a bun fight about something that didn't need to be a bun fight about. I thought, this is what happens when you get politicians who are far more interested in their own agenda or their party's agenda than they are in the interests of the country. And then I remember thinking, thank God that couldn't happen in Australia. Yes.
If I remember the numbers right, you're saying that the stock market will be at 5,500 by June next year, which is 10% above where it is today, and yet growth is much lower than that. Could you just explain that to me?
Well, it's not 10%. It's probably we're around 51.20, so let's call it closer to 7. It's a good point. Once I make those forecasts, I try to stick with them until every time you make a forecast, every time you change a forecast, you're admitting you got it wrong and you're giving yourself a chance to get it wrong again. So I tend to stick with them. And when I look at that, I say, probably could be 100 points lower. It's intended to send a signal that there's still value there, but that the best part's behind us. I'm not going to quibble too much about the number. At the moment I would say 5,500. If I change my forecast every day, right, I might be 100 points lower than that. There was somebody up the back.
The real estate industry gets a lot of publicity on auction clearance rates. How accurate a guide do you think they are how the housing market's going?
Yeah, I see those. I see that. I don't pay a lot of attention to them, but you can't help but read them every Monday. Everything in housing is pointing in the same direction right now. It's only a question of the speed. Prices are going up. The approvals for the construction of new dwellings going up, although oddly enough not so much in Victoria, and lending for housing, the number of new approvals per month, basically everything's pointing in the same direction. So I would say they're consistent with the other message, but so we're in a housing recovery. But relative to housing, excuse me, Relative to housing recoveries that we've seen in the past, it's been a long time coming, and it's not very rapid. And I guess auction, I don't get any extra information from auction clearance rates, but they do seem to be consistent with all the other indicators. Yes?
Chris, could you explain to us the current definition of unemployment? Because you mentioned earlier that we shouldn't believe what we're told, and there are often
Yeah.
we're told that people are employed or defined as employed if they work 1 hour a week, which obviously would distort the figures enormously if that's the case.
Well, it is true that you're not unemployed if you work an hour a week, but it's not true that distorts the figure enormously. Because it turns out, guess what? There's very, very few people who only work an hour a week. But it is, it is a good question. First of all, we don't count the dole recipients. That's not the unemployment figure. We don't even count everybody that doesn't have a job in Australia. We survey, I think, something like 30,000 households, which statisticians tell us is enough to get a reasonably good answer. But reasonably accurate answer. But these people get asked a question every month, asked a series of questions every month, and it's designed to figure out. You basically, if you're an adult in one of those households, you can be in one of three states. You can be employed, you can be unemployed, or you can be out of the labour force. What's the difference? You're employed. It's true if you work an hour a week or more. You're unemployed if you don't have a job, big surprise. And there's a couple of other things. You have to be ready to start if you did get one. And you have to have done something in the past month to find a job. If neither of those two things are true, you're not unemployed, you're out of the labour force. Now, as you say, 1 hour a week, that's the cut-off. But it turns out they do segregate the employed people into full-time and part-time. And the average part-time worker in Australia works 15 hours a week, according to the survey. And that seems right, doesn't it? Now, would you count a person who's working 15 hours a week as unemployed? Turns out you could if you wanted to, because they do keep track of two categories of people. Number one, those who have dropped out of the labour force because they've given up looking. So they, if you basically went to their house and said, "Come with me, I've got your job," they'd take it, but they've given up looking. And they keep track of those people that report, "Yes, I do have a job, but I would really like to be working more hours than I am." And if you add in those people, so people working fewer hours than they'd like to for economic reasons, and what they call discouraged workers, guess what? If you call them unemployed, you get a bigger figure. That's always been true, however, and that figure's quite a lot bigger. It would be in excess of 10%, whereas the officially defined unemployment rate is 5.7. But if you look at that chart I showed you, and you adjust to use that definition, the whole chart goes up. So relative to history, unemployment's still relatively low. Yes?
There's some reasonably large population countries in South America. World Cup's going to Brazil, Olympics are going to Brazil. We hear about Argentinian beef, Chilean wines, and blue gums. We never generally see South American countries on the chart.
Yeah.
Are they not insignificant in the world scene?
Well, you'd like to say yes, wouldn't you? But probably Brazil would be in the biggest 15 economies in the world. It's just that I'm an economist employed by a financial markets company or financial company, and so basically I'm interested in what markets are interested in, and there's not a huge amount of interest in that. I'm not saying that's the right answer, but yeah, that is the case. You'd think that Brazil would garner a little more attention than it does in particular.
Just in the interest of time, we might just about finish up there, Chris.
Yeah, thank you for your time.
One quick one. Just one more quick one to pose at you, given we've got a number of investors in the room, and it's perhaps been answered to a degree, but you've taken a sort of a global economic overview here, not so much from a macro perspective, and from what you suggested, growth rates look quite solid going forward. Is there anything that you can see, perhaps in the next 6 months or so, that could create some sort of immediate issues, apart from maybe a political issue with Cyprus or whatever? But we've mentioned the US situation with
yeah.
debt, meaning again, is there anything else that you foresee that could create some problems in the market?
Well, if you're going to rule, I mean, the first answer to that question would always be, well, something geopolitical, something that shuts down the Straits of Hormuz and causes a spike in oil prices. Although even there, we're not as hostage to those things as we used to be. Beyond that, I guess I suppose you have to say, okay, look at the major economies. You've expressed a view. Where could this be wrong? And it's always tempted to look for where could you be too optimistic rather than where could you be too pessimistic. But going on the pessimistic side, yeah, maybe I find it very difficult to believe that after all these years, there's something buried in the European financial system that we don't know about. And that was really the cause of the GFC. The stuff that was buried that we didn't know about. But I suppose I would have to concede maybe that's a non-zero probability. But I don't think. I mean, it's difficult to identify any major risks domestically. I guess in Australia, the risk is that. The mining, I've said the mining investment boom seems to be an orderly retreat at the moment. Suppose that becomes disorderly. I suppose it is possible that growth in Australia will slow more than I've suggested.
All right. Thanks again,
Thank you,
Chris.
David.
If you could just join me in thanking Chris for his presentation.